The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. Hello there, George. We looked forward last week to NVIDIA results with the comment that we shouldn't expect too much because they are, after all, at the wrong end of the whole supply chain. But they did impress. The ongoing super high gross margins continue to amaze me, given that they are shifting towards making more things with more bits and pieces from other people. And they're getting more interest from ever more customers around the globe. But the excitement, I think, was obviously Sage.
So yes, in terms of the UK world, absolutely. But sort of rolling back slightly on NVIDIA, absolutely the KPIs trend line improved. But could I just tie you into the rule of 40? Now, what you'll say, George, is that it's not a rule of 40 company, but Tarry, it's at a very impressive 105%. However, that 105% is down year on year from 160%. Which itself is down from 318%, which itself was up from 28%. Hopefully, I've just drawn the picture of a hump. It is now starting to drift closer to the norm. If we want to define norm, you're right. We think immediately of Sage. So how was the print?
I won't say lackluster. It was solid, impressive, just into double figures or around that area. It does consistently deliver, or has done of late, but the thing I can't get my head round is where the growth is coming from. How much is price? How much is additional services? Is there anything extra coming through from AI? And how much is just Intacct driving through and saving this business from a rather soft and unexciting UK customer base in the SME space?
Try to get my head around the new customers, because new customer acquisition is hard in this market. It is fiercely competitive as a space. We'll both remember the time when Intuit quit the UK, saying it's just too hard here. One of the stats I'm most interested, though, in Sage is the percent of ARR from new customers. And that number's been stuck in a very narrow band. It's between 8 and 9%, hasn't really budged. So their struggle is going off base and bringing in new folks. Your growth assumption, it's about existing customers, is absolutely correct. Also, you're correct from a product side. It's been driven by the Intacct guys. Now, Intacct, they're on the M side of the customer base, i.e. Sage's customers are SMEs. M's are the mid-sized guys, so they get higher average prices in there. And then the other side that Intacct has been able to do very successfully is work the expansion story. They have got a really nice AI product insertion tempo this year. Now, that previously they had a slow start. Sadly, what it's not translating into is a big increase on their cloud native revenue. Yes, it was up 23% to 885 million.
Which is Intacct, of course.
Which is Intacct. But the other side is that it's only 34% of the revenue mix, telling us that the majority of the customers are still at those Cloud Connect, which is basically a 365 license on your desktop. When I look at other people selling accounting and financial software, that number is 65%. So the struggle for Sage, it has not achieved an effective migration from desktop into cloud. And now, as you alluded to, we've got another migration opportunity, which is AI-based systems. One of the other prints this week was Intuit. Intuit, of course, being a competitor of Sage's, and they banged out numbers in line. But the surprise there was they have inked a $100 million deal with NVIDIA. Intuit plays a wide game. It's got lots of mom and pops, so at the low end of the S's, and in fairness, not as high up in terms of the M's. So it sort of sits in the middle, veering towards the bottom end. And I confess, that deal was not NVIDIA, it was with OpenAI. You're going to say, George, yes, it is. It's the same one. What they're looking to do is basically power Intuit's proprietary financial data huge domain expertise, credit models with AI's platform capabilities. So that could be a really exciting product map that they're going to come out with.
Do you think anyone will lose any accounting customers because they're not on the button this month, the next 12 months on AI?
Accounting is a heartbeat function. You don't just chop and change. I recall a discussion with Helen. So Helen is an SME. She's got her own IoT business. And we were discussing at this sort of entry level, there are so many offers available. And this would be pitching sort of entry prices for Sage on its cloud native stuff against Zero, against Intuit. And then you've got a whole host of other players in there. And Helen put me in my box really quickly, saying, my job is to run the business. What I want from my accounts package is just stable, reliable, something that I can trust. That said, when you talk to vendors at the entry level, their big concern is CAC recovery because they've got to flog the stuff so cheaply. You're trying to make profit then from these customers, which in fairness, in terms of the product stack, Intuit being the golden child at the moment, makes loads of sense.
The big thing they market on is how easy it is to transfer Sage data into Intuit or Zero into Sage, should that ever
I'm sorry,
happen.
Ian, I think last week when we spoke, as you went through the narrative on open APIs, well done, Sage. They had their own for a long time, and now they have an open API. So no, the point to that is exchange of data, as we're seeing from that whole fintech community.
So where does it go from here? I don't see how it builds itself into a global business just on the back of Intacct. X3 is new refurbished, should we say, in Europe.
So look at it from an investor point of view. It's great TSR, maybe not so recently, but its TSR principles are basically on returns. So gives a good dividend, buy it and close your eyes and, get your sex and violence in your portfolio elsewhere. But if you're thinking about sort of long-term planning, I need an income stream, Sage will offer that. You're also talking about something else in the sense of where does it go, not just from the investment case, but in terms of the underlying company. And for years, London has been at odds with trying to grapple with that. You could go back to the old founding days when it was a huge M&A story. They've stepped back from that. Now, clearly, they're in a net debt position. I mean, net debt EBITDA is only 1.7 times. No one is going to say that's any kind of barrier to raising money. As you know, sadly, I tend to be a supporter of expansion strategies such as M&A. At the moment, the market wants to do share buybacks, and I can't argue with it.
My worry is that the institutional investors have effectively marked this company down as this is what this business strategy is. Hello, world of tech. If you want to look at how Sage is going to react in any competitive situation, here it is in our dynamics of what we want in terms of share buyback, in terms of total shareholder return. It pretty much condemns it to fighting its own corner in the UK, having a leading strong position here, but one hand behind its back everywhere else it goes.
And to make matters worse, we're looking at Visma. We don't know for sure, but Visma is one of the companies that have talked about doing an IPO in London. Visma is far more aggressive in terms of using M&A to expand into new territories and across its product stack as well. Also to be a big size. And if you think of one of the things that Sage benefited from was that it was the biggest in terms of the FTSE company. Investors have the potential of having a clear compare to look at what's the best business model, what's the best route to generating returns for shareholders.
But we know that already. It's called Intacct.
Very good. Yes, but I can understand how they get there. I would be more aggressive in terms of the M&A, but at the same time, I'd say hang on for now, because if you're trying to bridge into the AI world, now the point you didn't make discussing NVIDIA was the concern that NVIDIA would come out with a rubbish set of numbers and the AI bubble would burst. There's a lot of potentially exposed AI native companies on very little revenue streams, but with cost bases. So the smarts at Sage could be hang on for now, wait for the bubble to burst, and then pick up some really interesting AI native software companies.
Well, AI people as well. They'll be dropping out.
Absolutely. And also when I look at the narrative from Visma, what I'm not getting from them is a strong AI story. Rather, I'm getting a strong SaaS story and just making me think that they're stuck in that transition. They're making text digital, the transition from Excel, the transition from desktop in terms of the technologies they're looking for.
Applying AI across the range of their products, because there is a huge range of products they've got after all their acquisitions. They're not all working on one platform. They're working on many platforms.
Absolutely.
Which makes them a candidate for all the gains that could be happening with AI coding going forward to say, here's an AI model, sort our software out. But I think that's a long way off.
Or so we thought. Part of the deals that NVIDIA signed was a collaboration with Intel, and they're looking to jointly develop a custom data center and PC products. Ian, they're talking about the opportunity to migrate the x86 CPU world to GPUs. I mean, wow, what an opportunity that is. So we in the corporate world could be using NVIDIA chips.
But would we know and would we care?
Otherwise, Ian, did you see anything else in terms of the London market that caught your interest this week?
Well, the other thing that came along, the tracks, shall we say, was good old Tracsis, which new chief exec in place, David Frost, taken over from Chris Barnes. Slightly different style. Chris Barnes, very enthusiastic. David Frost is getting to grips with the business. He does have a background in Internet of Things, so maybe he's thinking about this business in a slightly more conceptual way as to where it can go and how it is going to add value. He's got his work cut out. There's clearly not a lot that's going to get people excited about this business in the short term because of what's happening in the UK rail world. We're all waiting for positive news. The US poised for takeoff, supposedly. International, I think last few years we were all thinking, oh, it's growing there, it's going to grow, there's potential. But I think there was a little bit of downer on that in the presentation and the communication this week, which was the need to go and spend on making it SaaS native, as they referred to it, because it would appear that what we have in the UK in terms of their product set is very much a leaden lump rather than a series of neat little modules that all fit together around a series of rules for flexibility and international expansion and scaling. No, we've got a British rail software system that needs rewriting.
When I look at them, I see a gross margin of less than 60%. And I also see a point-in-time revenue of 70%. Where you're taking the discussion is a view that there's an awful lot of technical debt in there, which makes the investment case even harder.
I think there is a lot of technical debt. But then again, we possibly have to start thinking about these things and say, maybe not everybody actually wants to be going along this path quite as fast as we think they should. Maybe there are plenty of customers out there who aren't going to be that bothered, who don't mind having a bit of on-prem kit or don't have to have a completely scaling solution that just clicks in at the press of a button, because the way they think historically has been, we do long projects and long projects is how we get comfortable and know things work. We don't expect our suppliers to turn up and flick a button and everything works.
You're reminding me of a point Doorstopper landed, the McKinsey State of AI report. So on one side, 88% of firms now use AI in at least one function. However, only 6% of firms have any kind of aggressive usage. And from that, they're the only people who are getting any kind of EBIT upside from it. So it's very much in tune with your views in terms of the pace of technology adoption. I don't know if we've come full circle in terms of trying to get our heads around Sage's challenges in moving its customer base from desktop to cloud. But at the moment, the laggards seem to be in the ascendancy.
Well, we even had one last week, which is, Shearwater, the small reseller, distributor, value-added reseller consultants in the cyberspace. They've also got a software business which does cybersecurity stuff. And they were coming through and saying, look, we've been developing this software, but we actually have customers, because our customer base on one side of the business is quite large enterprises like telecoms businesses or banks. They quite like on-prem. Heresy, I know.
Well, on that bombshell, how lovely to chat to you, Ian.
Well, good to talk to you.
Brought to you by Progressive Equity.